On Friday, the FTSE 100 fell 1.8% to 10,186, its sharpest single-session drop in weeks, and inside that decline, one company hit an all-time high. Hiscox, the Lloyd's of London specialist insurer, surged as much as 15.3% to £18.90p, a price it has never traded at before. That gap, index collapsing, one constituent reaching a record, is the signal that the rest of Friday's session cannot explain on its own. The selling was broad and mechanically coherent. Gilt yields spiked to an 18-year high above 5.17% after Greater Manchester Mayor Andy Burnham announced his intention to contest a by-election in Makerfield, positioning himself as a potential challenger to Prime Minister Keir Starmer. Yields on 30-year gilts briefly touched 5.815%, a 28-year intraday peak. When government bond yields rise that sharply, utilities and rate-sensitive sectors bleed, and they did. Severn, Trent, National Grid, United Utilities, and Centrica all dropped sharply as investors rotated out of yield proxy equities. The pound fell 0.3% against the dollar to around $1.336, with the euro pushing above 0.8700 against sterling for the first time in 5 weeks, extending its best weekly performance against the pound in 8 months. The political mechanics accelerated the sell-off. Wes Streeting's resignation as health secretary was the latest in a string of cabinet departures, and gilt traders who had already been watching the Labour government's fiscal position read the Burnham move as a potential pivot toward higher borrowing commitments. What markets priced was not a leadership contest, but a fiscal regime change. Against that backdrop, miners, energy names, and the broader index moved in lockstep lower, but Hiscox did not move with them, and that refusal to follow is not explained by the political narrative at all.
The Insurance Post reported that Canada's Intact Financial Corporation, a property and casualty insurer listed in Toronto, is actively exploring a takeover of Hiscox. Intact's chief executive has been publicly identified as a buyer seeking a large international target, and the report named Hiscox specifically as a company he has long followed. That sent the stock to its record high, in a session where the index it belongs to shed nearly 2 percentage points. The mechanism here runs counter to how domestically focused investors are reading Friday. A political crisis that raises borrowing costs, weakens sterling, and signals fiscal uncertainty is, from a foreign acquirer's perspective, a discount window. Sterling at 1.336 and falling means a Toronto-based buyer acquires UK assets at a lower dollar equivalent cost than 6 months ago. The weaker the pound gets on political noise, the more attractive the pound-denominated asset becomes in Canadian dollars. Intact is not buying the UK political outlook. It is buying the gap between what Hiscox's Lloyd's platform earns globally and what a risk-off London session has priced it at. Hiscox is not a domestic utility or a rate-sensitive bond proxy. Its earnings come from global specialty insurance lines, cyber, catastrophe reinsurance, marine, and high-value personal lines, underwritten through Lloyd's of London. The businesses that dragged the FTSE lower on Friday, the utilities and miners, are structurally exposed to UK fiscal conditions. Hiscox's underwriting book is not. That insulation from the domestic political cycle is precisely what makes it a target during a session like this one, not despite it. The 15.3% single-day move in a falling index priced in a control premium, and the fact that no competing bid has emerged yet means that premium is still open-ended. What this move leaves unresolved is the question of whether Intact will formalize an offer, or whether the initial report overstates the likelihood of a transaction. Hiscox's shares are now priced at record levels without a confirmed bid. If Intact walks away, the correction will be steep, and it will land in a session already defined by political and fiscal anxiety.
Hiscox is not an isolated case. The Guardian noted Friday that this makes Hiscox the latest in a sequence of UK takeover targets this week alone, a pattern that, set against the FTSE's underperformance relative to European and US peers, points to a sustained foreign appetite for London-listed assets that domestic investors have been re-rating lower. The logic has a precedent. After the 2016 Brexit vote, the pound's collapse triggered a wave of inbound M&A into UK-listed companies as overseas acquirers moved on sterling-denominated assets they judged to be fundamentally mispriced. The political discount and the acquisition premium were two sides of the same event. Friday's setup rhymes with that window, with one important difference. In 2016, the discount was currency-driven and the political outcome was resolved. There was a binary event with a clear result. The current UK political uncertainty has no equivalent clearing date. A Labour leadership contest, if triggered, would run for months. Gilt yields at 5.17% on the 10-year are not a reaction to a single announcement. They reflect accumulating fiscal concern that predates Burnham's by-election move. The 30-year gilt at 5.815% intraday means the bond market is not pricing a short-term political wobble. It is pricing a structural question about who governs, on what mandate, and at what level of public borrowing. For Hiscox, the verification benchmark is the next regulatory filing or public statement from Intact Financial. If Intact confirms it is in preliminary discussions, the all-time high of 1890 becomes a floor, not a ceiling, as competing bettors, European or American insurers with their own sterling discount exposure, may re-examine the same arithmetic. If Intact confirms it has stepped back, Hiscox reverts toward pre-bid levels, somewhere in the £16 range, and the day's 15% move collapses. That outcome would also land against a backdrop of continued gilt pressure and a pound that has not recovered. The question the session leaves open is not whether UK assets are cheap. The foreign bid flow suggests the answer, but whether the political discount widens faster than acquirers can close deals. If gilt yields push above 5.3% next week on fresh leadership developments, the currency advantage for foreign buyers grows, but the execution risk of completing a transaction in an unstable political environment grows with it. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.